When deciding whether to work at a company or start your own business, in both cases, you're going to have bad days. And the question is, what do you want your bad days to look like? And in a corporate environment, a bad day looks like frustration usually. Whereas in the entrepreneurial path, the negative emotion tends to be fear.
This is Net Learnings, the podcast that keeps finance and banking professionals ahead of the curve. In each episode, we focus on career growth and practical advice, while mixing in the occasional war story. Join us as we tap into the minds of leaders and experts at some of the world's most notable financial services firms and enterprises. Let's get started.
Hello and welcome to Net Learnings. I'm your host, Kyle Peterdy. We're fortunate today to have another really interesting guest in David Jens. David is founder and CEO of not one, but two FinTechs. The first is Merchant Growth, which was founded in 2010. They provide cash flow financing for small businesses. And in 2022, David co-founded Tabit, which is a buy now, pay later solution supporting B2B e-commerce. Throughout his career, David has had considerable exposure to private equity, private debt, and asset management. And he brings both a wealth of experience in finance and a really unique perspective, having seen a lot as both a financier and as an operator. David also co-hosts a popular podcast called FinTech, a bi-weekly show that highlights all things finance, FinTech, entrepreneurship, and banking. David, it's a pleasure to have you. Welcome to the show.
Awesome to be doing this. Thanks for having me.
So to start, can you tell us a little bit about Merchant Growth and Tabit? Maybe more specifically, what problem or problems are they solving respectively?
Sure. I'll start with Merchant Growth, which is the older of the two. And really, it's solving two problems, and they're kind of related. The first problem being that small businesses have a really challenging time finding credit. The options available to them are, much narrower and more limited than, mid-market companies or larger corporates. So typically a small business, picture your typical B2C storefront business, for instance, although we do serve a lot of different verticals. When they go to the bank looking for a loan to expand their business, typically the small business loan officer is going to ask them what's the value of the home that they own personally and whether that can be, leveraged to help grow their business. If the answer to that is, I don't want to put up my home or I don't have a lot of equity left in my home, then typically they leave with either nothing or maybe a small credit card, but no meaningful financing for the business. And, there's a number of reasons behind that. Complexity of underwriting small business credit, the risk inherent in, the highly competitive industries that small businesses operate in. It necessitates kind of a different approach and pricing model to a lot of other types of credit. So, and it's a small market. So the banks tend to just not really focus too hard on it, frankly. So there just simply isn't a lot of access. And so one thing we're solving is just providing capital where traditional financial institutions don't. The second problem is around convenience. Small business owners are wearing multiple hats and are time strapped, and their time is valuable, right? And they want to get back to running their business and trying to figure out how to finance some working capital need, seasonal working capital inventory, some kind of expansion need. It's a pile of work that if we can get them back to running their business by making, a financing experience really convenient, as few clicks as possible, get them back to running their business, that's delivering real value to small business owners. So it's both access and convenience, which, dovetails well into the mission statement of Merchant Growth, which is to bring Canadian small business owners the most convenient and accessible financing experience. So that's Merchant.
It's got a nice ring to it.
Yeah, thanks. So, that's Merchant Growth's, value prop and mission. And then Tabit is an evolution of the business. So Tabit as a product powered by Merchant Growth, it's a new brand because it's a bit of a new approach to the market, new business, but it fundamentally leverages a lot of the skill sets that we have come to hone in on over our decade plus in business at Merchant Growth. And so what Tabit is just bringing that convenient financing experience at point of sale for small businesses when they're buying from their suppliers. I can't think of a more obvious moment to show up as a financing option than at the time of purchase, for goods and services from a supplier. A lot of the time in Merchant Growth, we're making loans to businesses who are in turn using that capital to procure something. It only makes sense for that experience to be available at point of sale, which involves, wrapping, taking a credit product and wrapping it into a payment option, essentially. which, was, not the simplest thing, took some work to get there.
I'm sure.
But now that's, available across the country through a few merchants, and we're really excited about scaling that.
That's super interesting. You actually answered a question that I had intended on asking you later. I don't know if it's a silly question, but is buy now, pay later, BNPL, a payment product or a lending solution? And I guess it's sort of both, right?
I would say it's sort of both. Yeah. Like, I do think that one of the new players in BNPL, which is buy now, pay later, particularly in B2B buy now, pay later, which is the newest type of BNPL, you're seeing a lot of folks pop up and really focus on the payment tech, making sure that flows really nicely. They don't come with a strong underwriting model or a decade plus of underwriting experience in the credit category. And
Right.
that's sometimes we forget that actually it's a loan, and you have to do a great job of adjudicating credit so that you can have a healthy portfolio and have happy funders of that portfolio that continue to support your growth and so on. So, I do think at its core, you need to be a good underwriter. You need to be good at risk management in order to offer this type of product.
And you have no shortage of experience in that space with SMBs for sure. So regulation is an important thread, and I imagine we'll pull on that a bit here today. There are, of course, two sides to that really important coin. It's what we're told, at least, makes the legacy financial system as safe as it is. Of course, the flip side is friction for the consumer or for the business owner, and you alluded to that. It's not always a quick process. I feel like most people would argue that virtually everything they do in their life is easier now than it was 10 years ago, like literally finding a ride, going on vacation, you name it. But if you took a random poll of like 500 or 1,000 average consumers, they probably wouldn't say that about their banking relationship. So this is something that the community of financial services professionals, I think, are wrestling with and trying to reconcile this sort of need for, but distaste of regulation. And I guess my question is it even possible for fintechs to simultaneously reduce friction and increase speed without sacrificing safety and security from the consumer's perspective?
Well, I think that there's plenty of potential, and already we've seen some of this play out in terms of a bank working with a fintech. So, the bank is effectively a utility that, as a result of its bank charter, can take deposits, and it always will have the lowest cost of capital because of that. And there's certain things that the banks, will do well, and the regulation helps them do that well. And then that can kind of be married with fintech offerings that really provide the front end layer that drive convenience, use data science to, make recommendations or good decisions and reduce the number of clicks to get through something. And, just like give us that level of convenience we've come to love from, the likes of Uber and other apps you kind of alluded to in your previous comment. So, I think that one thing that's unfortunate in Canada is that we don't have an open banking framework that's as advanced as the UK and some other countries. And so, what open banking really is regulation that forces the financial institutions to let consumers and small businesses, anybody with a bank account, control their data and permission their data, share it with fintechs. By doing that, any fintech, even if they're not partnered with said bank, could access your data and then offer you, value-added services through their offering. But without being able to access that data, like right now, there are some workarounds, but they're kind of, they require typically a customer to log in with some regularity, and the connections can break and sometimes they fail. It's not really a great system. And so, the fintech community was really excited, hoping that this federal budget 2023 that we just, received from the Liberal government, we were hoping it would have some open banking stuff in there, but unfortunately that didn't happen despite promises that it would be in there. So, hopefully the government will get along to it. Obviously there's lots of priorities, but this would be one that would really accelerate fintech innovation. And yeah, I think you can definitely create a lot more convenience, less friction, and not necessarily sacrifice anything in the process, and really work with banks, not against them.
You've alluded to like a very Canadian specific issue. Are there any jurisdictions that are doing this really well in terms of marrying sort of open banking, fintech, and the legacy financial system?
There are, and there's a number of European countries. The UK comes to mind. My business is Canadian only, so I read about some of this stuff, but there are folks who actually run international fintechs, and they would be a lot more well-versed in this topic. But I do know that, we really are falling behind in Canada on this point.
That's interesting. I mean, a little disappointing as a consumer for sure. For listeners that are interested in exploring a career in fintech or kind of thinking about what that may look like for them, are there any skills or resources that you recommend, like maybe thought leaders or authors, somewhere they can go?
It's a great question. Fintech obviously is a combination of finance and technology. So I think you kind of want to come in through one of those two paths. I myself really came in through the finance path. And, I run credit-focused fintechs. And I think having that really like anchoring in finance is helpful there. In other types of fintechs where, you're not necessarily providing credit, but you're just really focused on, making things really streamlined and, having really elegant front end that display things for people, so on. Then I think really a pure like software design, et cetera, is certainly helpful. Just a strong understanding of product. If you think it's an interesting space, decide whether, if you're early in your education and so forth, whether it's the finance angle that really excites you and plays to your strengths, or is it the tech side of things or product and design?
Well, you've given me an interesting natural segue because I actually did want to talk a little bit about your career journey, or your professional journey. Did you always want to be a founder?
I actually did. Yeah. Yeah. So I come from a family of entrepreneurs. My dad, my brother, and my uncle, they all had their own businesses. And so, I kind of grew up around that and the highs and lows, the stress. And, my dad was sometimes grinding away working, and didn't see him a lot and so on. But, also saw them get somewhere with it and accomplish some pretty big things in some cases and be proud of those things. And yeah, it's kind of more volatile than, just being in a job, but,
Right.
More interesting. Frankly, it was a friend of mine who's also a fintech entrepreneur, actually, Andrew Graham, the founder of Borrowell. He shared a statement with me that really resonated, and he got it from someone else. So we're just passing on some kind of wisdom here. That's
Shared
floating
wisdom,
around, but
collective wisdom.
yeah, exactly. But it was a great quote, which is when deciding whether to work at a company or start your own business, in both cases, you're going to have bad days. And the question is, what do you want your bad days to look like? And in a corporate environment, a bad day looks like frustration, usually trying to get somewhere or trying to convince someone of something, get some kind of approval, etc. It's just frustrating. Whereas in the entrepreneurial path, the negative emotion tends to be fear. Am I going to completely fail and everyone's going to think I'm a failure? Am I going to, miss payroll because cash is tight this month or whatever it may be? So it's like a real like fear emotion instead of frustration. So it's kind of pick your poison. Which one do you like more? I thought that was just a really interesting way to think about it. And I don't think there's a right answer to that, right? It's really like you got to kind of have to think about it for yourself.
Yeah, that's a great lens to actually think about it through. So you talked about having come the finance route as opposed to the technology route into fintech. And I want to unpack that a bit. Coming out of business school, you were on a really high profile trajectory, right? I mean, you did the portfolio management program and you went into private equity. I would consider that to be sort of a holy grail for a lot of, young finance undergrads. It's going back a little ways, but what sort of skills, circumstances, or experiences do you think helped you achieve that early success?
Yeah, I was definitely very lucky to get into UBC, to be part of the PMF, the Portfolio Management Foundation, and to get the job that I did. And so, very grateful for that. I am grateful now, and I was then, for that opportunity. And it wasn't my plan to, I only worked in private equity for about a year and a half before starting this business. My plan wasn't for that stint to be that short. That's just kind of what happened. An idea came up, business idea, and, I dove in. But the plan was to kind of get a little more experience, grow the network more, et cetera, prior to becoming an entrepreneur, although that was always the end goal. But yeah, it was a little bit of a freaky decision, of course, having got to that place and having that, great job that was going to continue to be a great career had I stayed in it. So it did make me, have to think a little extra hard about it. But yeah, at the end of the day, though, another piece of advice I got early on was sort of like, the earlier you get started as an entrepreneur, the better. There's a lot of truth to that. It's not black or white because, some business types, if you want to be an entrepreneur in them, like having a little more experience in that particular industry is going to just like help you hit the ground running when you do start. But, generally speaking, like there's always a reason why it's a bad time. And if you're, want to do it, you might as well do it and get going. And at the end of the day, like it takes a long time to build a business. So the earlier you start, the more time you have, right? So, I dove in.
It's funny. It's always easy to find reasons not to become an entrepreneur. I feel like everyone sort of runs through that mental checklist and figures out why there's a better time, like tomorrow or next week or whenever that happens to be. So great advice. Thanks for that. Were there any kind of interesting learnings or takeaways you had from your brief stint in private equity? Maybe like some myths or misconceptions about that space?
Yeah. Well, what I liked, I don't know about if this is like myths or misconceptions, but what I did like about it was that you're pretty close to the entrepreneurs. You're really getting into some level of detail. I mean, different private equity firms have different approaches in terms of how hands are they with their companies and so on. Depends on like where they believe they add their most value. But as opposed to, trading in publicly traded securities, in private equity, you're actually, participating, observing board meetings and like assisting with strategy and M&A and like so on. So that was really fascinating. One thing you learned as well is that in venture capital, you really ride your winners and you're kind of quick to mentally write off your losers because that's not where you get your fund return. It's from your winners and hopefully your winners being really big and you just need a few in one fund to make that fund work. In private equity, right, you're kind of targeting a more narrow band of outcomes. And so you end up spending a lot of time trying to mitigate your losses, which is a little different than venture capital where you just kind of like move on to the next one.
That's interesting.
So, which is like, there's good and bad elements to that. Like there's tons of learning in that. And like, you're in there trying to figure out how to like, why did something go wrong? And how do we try and like right the ship? And you end up, almost working on some turnarounds here and there to try and, like that'll have a big effect on your fund return. So yeah, it was a fantastic place to learn, especially if like entrepreneurship is likely where you want to go next.
Was there any particular person along the way that really was helpful to you?
Absolutely. Yeah. I don't
maybe
think
maybe a long list. I don't know.
Exactly. Yeah. I don't think there's an entrepreneur out there who would say like, no, there's always a lot of people that end up helping you out. Oh man, it really is a long list.
Well, no pressure.
No. I'm happy to like, maybe I'll answer your question just by soliciting a couple, which is one is my boss from the private equity firm, Tracy McVicker from CAI Capital Partners. She was just an awesome supporter. And despite the fact that I left the firm to do my own thing, she's been like a huge supporter ever since. And someone I can always go to for a bit of advice. And that's great. I had a few, board members along the way that really helped expand the network that my business essentially had access to. That was helpful in terms of capital raising, but they also provided really good advice along the way. Folks who would just have a decade or two more experience as entrepreneurs than myself to help me sort of think about some of those problems. And then more recently, I joined YPOBC, which has been also a really great experience in terms of kind of peer learning, shared experiences with other entrepreneurs. So yeah, huge value to having people that you can bounce ideas off of and also share experiences to help navigate complex situations.
Right. I don't know Tracy personally, but it's interesting you mentioned her because we do have a number of mutual contacts and every single one of them has nothing but ringing endorsements for her as a professional and a person. So not surprised to hear that. On a scale of 1 to 10, how important in general is networking in terms of career development and mobility? You've kind of spoken to it here.
Yeah. I mean, it is important. I kind of think of like every interaction, like not just make it sound too transactional, but it's like a free call option. Like you never know what might happen, right? So like you might as well go out and meet lots of people and see what that might do, right? And at the end of the day, like people help you out along your journey, like I mentioned earlier. And yeah, I think, there is some nuance in terms of like type of business and like its relative importance on the networking. Some business types are like super business development, sales heavy or involve a lot of raising capital. So, and others, are maybe simpler and like don't require as big of a team or as much capital raise and you can kind of pound away at them without having to talk to too many folks. So I've seen both, but I certainly enjoy meeting new people and learning from others, and I've gotten tremendous value out of it. So I would say it is pretty important.
You often hear as you become more senior in your career, new opportunities don't typically come from what you know, but rather who you know. It's easy to get your resume lost in a stack of hundreds, but to be able to pick up the phone and call someone who knows someone is really meaningful, I think.
Yeah.
So there's an old adage that a mistake is only a failure if we don't learn from it. My question to you, is there a really meaningful mistake or misstep that you made along the way? It's maybe something you can, laugh about now, but that might have felt really devastating at the time.
For sure. And frankly, I could give you a multiple part answer here too.
A true entrepreneur.
Yeah. You end up with a few scary situations over the years. The first one that popped into my mind was the first few years of the business. We're making loans to small businesses, and we had no choice but to be a bit concentrated in the book because the book was just so small. And I had two of my biggest clients, which was like close to 20% of my book at the time, fail in the same week.
Oh my God.
That was one of those, am I going to make it to the other side of this sort of moments? Because, there's a certain loss rate we expect in the business, but it's certainly not, 20% of the book in a single week, So, I mean, the lesson there were underwriting lessons there, like reasons why we should have declined those loans, not done them in the first place, for sure. And then the other lesson just being like, don't have 20% of your book in two clients, right? And it's now our loan portfolio, like our biggest position is 50 basis points.
Wow.
So yeah, we're talking, actually north of 10,000 loans and just really small exposures. And, we're cash flow lenders. So any particular exposure can end up being a zero. But, we're lenders and we strive to deliver a consistent return to our LPs, commensurate with what you would think in a credit fund. So, the way we get that nice and smooth is through a lot of diversity in the book. So, those are lessons that were certainly learned in that experience. And what was fascinating about that particular experience is, I had this like, are we even going to make it to the other end of this? And surprisingly, when I reported to all the investors, I wrote my letter, explained what happened, and, posted the negative number and like all that. I actually had more people putting in money after that, which was like amazing to me. Right. And not what I had expected. And I think the reason was, it's to your point, is like how important it is to learn from your mistakes. Yeah. And then if you do that and you really do that, you really like take it to heart, and then you like explain that, you take accountability, you explain it to everyone who you work with, people see that something was learned and that the future is probably going to look brighter than the past as a result. Right. And that's exactly the conclusion that a number of my investors had at the time, was like, this was a rite of passage. We had to deal with it. It's painful, but you know what? We're going to do even better in the future. So, and obviously that made me just extremely thankful for the wonderful investors I happened to have at the time. But yeah, and got plenty of other failure stories, but it would take all day to go through them all.
Fair enough. No, and thank you for opening up about that. I'm sure that's not something you necessarily want to think back on all the time. A lot of folks in the CFI community are actually on the other side of the table, providing financial services directly to corporates. You are now an owner operator. And so I want to talk about this concept of financial partnerships. You alluded to it, even saying you had great capital partners. What are some things you've learned or that you believe to be true about what makes a good financial partner versus a bad one?
Yeah, it's a great question. And I'll go as far as to say I've had both good and bad. And, at the end of the day, obviously you want your partners to be really intelligent and experienced and be able to provide good advice and add value and hopefully, leverage their network to get you ahead. Mm-hmm. So that's a given that you want to try and, find partners that have that, as opposed to, people who just stroke a check and they can't really do much else for you. But in addition to that, I just think it's extremely important that you align yourself with people that have shared values with you and, genuinely have a relationship with you that's, beyond just a transaction and, the self-interest involved in that. So people who want to truly see you succeed and want to truly support, because everyone's a good partner when things are going well. And you really learn about who the good partners are versus the bad partners when times get a little choppier. And so, yeah, that's what I would say really makes a good partner, someone who supports you through and through.
It's great feedback. I want to talk leadership management for a moment. When you're looking to promote internally, what sorts of skills or behaviors are you typically looking out for? Like, or more generally, how do you suggest that people stand out at their place of employment?
Yeah, I mean, I would say that, naturally you're usually talking about a shift from individual contributor work to, management level work. And the key shift being there, like as a leader or manager, you're judged on the output of your entire team. And your only job is to try and get your team to perform. So it is a mindset shift that some can make and some cannot. Some are just excellent at the thing they do, but managing a team is obviously a totally different can of worms. But, I have found that usually those that want to lead, they kind of naturally do. And then by the time you give them the job title, it's like, duh, they should have that title. They've already been doing that job for a while, So a lot of that just kind of happens naturally. You don't necessarily need to really force it, I would say, when it comes to promoting.
Let's go in a bit of a different direction now. You run obviously a FinTech lending operation, Merchant Growth, but you also run Merchant Opportunities Fund. And you talked earlier about your LPs. So I want to hear kind of unpack the fund side of it. What does Merchant Opportunities Fund do?
For sure. And I really take pride in how we've structured the business. I think it was a good way to structure it, and it's served us well. And really what we decided to do early on is to house the balance sheet in this funding vehicle and keep it separate from the operating business. There's a super simple math reason for that, because oftentimes balance sheet lenders, as they grow, if they don't do what I just described, then they're just lending off their corporate balance sheet. And as they grow, they get bigger and bigger debt facilities to fund their loan book, but there's always an equity component they have to come up with. And so they end up having to raise equity and dilute their equity ownership in their business just to obtain the first loss capital that needs to go into the structure and in terms of funding the book. And really the valuable, upside and the IP and the brand and the technology and so on, you're diluting your interest in that just to get money to fund the loans. And by separating the two, you can, raise capital in the form of fund capital, yield seeking capital that takes the equity risk in funding the book, and then, not diluting yourself in the operating business. So that was the first reason we did that. And then over time, the fund's initial purpose was just to fund the loans that Merchant Growth was making. And that's what it did for the first 6-7 years. And there came a time when the fund had excess cash and we started to actually make some other loans or buy loans off of other FinTech originators and further diversify what the fund held. And when we really put our fund hats on, we're investors in our own fund, and our friends and family are investors, and now it's getting more and more broadly distributed. But we run the money like it's our own, because much of it is, and it's only going to improve the quality of the investment product to have a few different FinTech originated loan portfolios in there, because you've got the macro credit cycle, but within each specialty finance niche, you're going to have their own sort of dynamics in terms of supply and demand, and how the returns are going in each. So it's in the world of equities, concentration is often a good idea if you know what you're doing, and that's how you're going to optimize your long-term return. But when you're just making loans and you're in credit, diversification, generally speaking, is your friend. And so you want a lot of different loans and ideally a few different strategies in terms of how those loans are being made.
And I'm sure you can leverage all the success you've had as an operator to get your foot in the door with some of these other operations and have a crack at, maybe buying some of that credit or getting involved as an equity investor. So that's an interesting way to
I appreciate you actually mentioning that, Kyle, because it's a huge point, and it's one we try to highlight a lot. There are a few other funds, not many in Canada, but certainly some in the US, that invest in FinTech originated consumer and small business loan portfolios. And most of those funds, they don't have that experience. They're just wholesale providers of capital. We know what it means to automate a complex underwriting decision. We know what the data science team needs to be thinking about. We understand the challenge of acquiring customers and so on and so forth. So that helps us relate to these groups, but also add value and be a good partner and so on. So could not agree more with that point.
So through 2022, we obviously saw an environment where interest rates soared, went from near zero to quite a lot more than. Has this changed how you think about risk and return and how you're communicating with your partners?
It's a huge change across the entire business world, really, but particularly when it comes to credit and non-bank credit, it's got, pros and cons. So like, I guess I can kind of list them out. Pros are that when rates go up, the banks are typically the first to tighten their underwriting.
Right. Yep.
And, prices, rates go up, of course, and that might lower some demand for credit. The whole idea with raising interest rates is to lower the demand for credit and increase the demand for savings. But so you'll have fewer borrowing, but those that want to borrow are also going to get cut off a lot more by those banks who are going to tighten up out of concerns for loan performance and so on. So that can present opportunity, right? Because it brings a lot of borrowers into these non-bank platforms. So you can actually see kind of a high grading of the funnel, which is a really nice positive effect in these times. Also, just tighter money conditions, tighter credit conditions kind of tilts the, negotiating leverage, into the favor of lenders versus when, money's really loose and, the borrowers kind of have the leg up. And so that can also be good in terms of like being able to get the yields you need to, make good risk adjusted returns. You can kind of command those in this type of environment a little bit better. So I think there's a lot of really compelling reasons to be in non-bank credit in times like these. And you can actually get a lot of portfolio growth, but you have to be careful because rates increase, that typically, brings the economy down a little bit with it. So you need to make sure that your underwriting is on point. And, you always have to be, underwriting for an uncertain tomorrow and playing a long game when it comes to credit, as opposed to just trying to be brave and trying to look like a hero when times are good, because eventually you'll lose at that game.
It's great perspective. I want to talk about the pandemic for a moment. Unprecedented, obviously, is a word we've heard thrown around a lot, and that's probably an understatement. Take us back to the early days of the pandemic. I'm thinking like business closures, lockdowns, general chaos. What was going through your mind as a small business lender?
It was wild. Lots of businesses, as you know, did great in the pandemic, right?
Sort of counterintuitively at the time.
But it was big businesses that did great, right? And even if you were like, brick and mortar, the really big ones like, Walmart and, big retailers and stuff, they found a way to navigate and stay open and stuff like that. It was really those kind of mom and pop small businesses that had to shut down and just wait it out and that was where we were doing most of our lending, as you know, right? So of all of the different non-bank credit strategies out there, I would say that we happened to be running the one that was just right at the nucleus of this pandemic issue. So it was very serious, and it began with a period of extremely high stress, and we saw a sizable portion of the portfolio kind of reach out to us or us reach out to them, basically acknowledging the fact that payments are going to have to pause. Like there's just no way they could continue as scheduled because everyone's just been shut down. So a significant portion of the book, not a majority of the book, but a significant portion of the book went into, a modified payment plan status. And we built these sort of decision trees around like, if you're in this industry and you're experiencing this scenario, then we'll offer this much of a, temp reduction in your payments. And so we put tons of folks on modified payments. Some that couldn't generate any revenue in this pandemic scenario had to close and went delinquent. So that was just, there was a spike in losses there, especially just right at first. Mm-hmm. When a business has no revenue, it can't survive long at all, right?
For sure.
And then, so we were very accommodative, right? We were very service oriented, and it wasn't going to do us any good to, try and, squeeze like money out of a stone when you can't. So we knew we had to work with our borrowers. Once the various Canadian government programs kicked in, and that really helped businesses kind of be able to manage from a liquidity perspective and sit and wait while the pandemic played out. Canada's response was very robust. I would say it was more robust than the US response, for instance, and it really saved a lot of businesses. So, we noticed throughout the summer and into the fall of 2020, just like an incredible normalization in our payment performance. So it not only normalized, actually, it was better than ever. And so that just speaks to the strength of the government response. And then, but the challenge in that environment was our volumes went way down.
You weren't originating any new business, I'm sure.
Yeah. I mean, it was initially like we dropped to 10% of what we normally do. Then throughout the next 6, 7, 8 months, we eventually got to 50% of normal, call it. And then we kind of gradually resumed from there. And it wasn't really until last year, 2022, where we really saw a full resumption to normal demand. And no surprise, it coincided with the end of some of these government programs, right? Yeah. So last year, 2022, we had, this phenomenal year where we had significant demand for credit, and we saw a ton of book growth, and we saw all-time record volumes and so on. But we also saw like this really benign credit environment with very low loss rates. And I think that was still from like a lot of that government injection kind of being in the system, which was helpful for credit performance. So yeah, I mean, to cut a long story short, it was very volatile and it started out really scary, and then it actually ended up being just fine. And we kind of had to, just work on our operation and keep building technology and getting ready for the big rebound that we knew was coming. But it did take a few years before it actually materialized.
Well, I guess my follow-up to that then is, did it change the way you think about risk, especially tail risk events like that?
Yeah. So we certainly don't expect like government stimulus to come in and like help the entire small business community the way it did in the pandemic. And in a typical recession, it won't, right? And so we're underwriting with that understanding, and we are cognizant of which industries are discretionary spending driven and, which are more resilient in a recessionary scenario. And we price that risk differently and accordingly. And that's a very unique tail risk, right? The pandemic. It's nice to know that if we ever have another one, that's probably what'll happen again. And the government is going to effectively help there. But, that's a tough risk to model. And fortunately, the government, and not just in Canada, but globally all around the world, there was a recognition that small businesses really needed the support during that time.
Yeah, makes sense. Kind of a random question. Is finance a numbers game or a people's game?
I hate always hedging my answers, but I got to answer that it's both, because to grow a business, you almost definitely need to grow your team, right? There are some businesses that can grow without having to add as much to the team, but you need to build a team and support your team in order to get anywhere as an entrepreneur, in finance or any other sector for that matter. But incredibly important to know your numbers, because I've seen a lot of entrepreneurs get everything else right, but they don't spend enough time in the model or understanding the model, and, just over leverage or imprudence with expenses, can ultimately end up sinking them. So you got to have both under control.
I like that answer. Classic business school answer. A little of both, right?
Yeah.
And it depends.
Yeah. I mean, like, I love that book by Howard Marks, The Most Important Thing, right? And
Great
each chapter, he's like, each chapter is another super important thing. Like, there's a reason why it's kind of hard to be successful in business, because there are a lot of different elements you need to get right.
That's a tremendous book for any finance enthusiasts and investing enthusiasts that's listening, by the way. Very, very good plug there. David, I want to be respectful of your time. You've given us a lot, but maybe just one final question, if I may. If you weren't running your own business, what would you be doing?
So, what I would probably be doing is, I was just this is like really getting off of the finance track here, but
okay.
I think maybe that's where you're going with your question. I don't know, but
sure.
I grew up playing music like really passionately, and I actually toured with a bunch of different bands.
Wow.
At one time I thought it was what I was going to do with my life, but I was kind of too entrepreneurial, and I had to recognize, just how dicey of a plan it is to, try and be a rock star. Right. So, I ended up shelving that for FinTech and entrepreneurship. But, I still play, and I miss it, and I love it. And so that is perhaps what I'd be doing if I wasn't doing this.
It'd be a pretty interesting way of life too. If members of the CFI community want to learn more about you and your companies, where can they go to find that?
Merchantgrowth.com for, Merchant Growth, Tabit.ai for Tabit, and merchantopportunities.fund.com for the fund. And, we're a broadly distributed fund. Most investment advisors can buy that through FundServe. So feel free to reach out to us if that's of interest for your portfolios. And feel free to find me on LinkedIn as well.
That's terrific. We'll leave some of that in the show notes. And for our listeners that are interested in learning about financial technology and want to really double click on that topic, I'm actually pleased to announce that CFI recently went live with an introduction to FinTech course too, which is actually free and absolutely worth checking out. David, this has been incredibly insightful. Thank you again on behalf of the entire CFI community. Folks, until next time, never stop learning.
Thanks for listening to this episode of Net Learnings. This podcast is powered by CFI, an organization on a mission to enhance the skills, knowledge, and productivity of finance and banking professionals. If you enjoyed what you heard in this episode, make sure to follow Net Learnings wherever you listen to your favorite podcasts, or visit us online at corporatefinanceinstitute.com/podcast. See you next time.